Hi, I'm Jimmy. So, one amazing type of stock is a growth stock. I'm sure many of us know that. But what if we could buy that growth stock at a reasonable price? Well, many times this is known as GARP, or growth at a reasonable price. In this video, we're looking at what GARP stocks are and how we can identify good GARP stocks. Then we'll look quickly at some examples of growth at a reasonable price stocks, and we'll look at how we can compare them to their own industry, some numbers we can use to compare them to. Now, as many as you may have heard, we launched a private investing community where we do weekly live streams and we chat in our investing Discord. So if anybody wants to jump over and join that private community, I'll leave a link in the description below to the Patreon page that will give you access to that private investing community. And we've actually got a private live stream today at 1 o'clock Eastern Time if you want to join us. And interestingly enough, this video idea for GARP stocks, for looking at different GARP stocks, actually came from some of the conversations that we're having with people over on the investing Discord. Okay, now let's jump into some GARP stocks. So first, let's define what would typically be classified as a GARP stock. When I first heard about GARP stocks, I had all sorts of questions. What is good growth? What is a reasonable price? How do you define those numbers? And clearly, growth is going to be a big part of this. So the first factor that I think we should look at is growth in both revenue and earnings. And since the stock market tends to be forward-looking, we're really looking for expected growth in these two areas. Now, many times we can use a company's history to try to project out growth, but that will really take a deeper understanding of each company. We're going to get into how we can quickly define that in a minute. But the key point for us to remember here is that it's not just growth in profit, but it is also growth in revenue that we care about. If it was just growth in profit we were looking at, well, a company in theory could improve their margins. They could cut expenses, improve their margins, and their profit would rise, but revenue might not be rising at a good pace at all, so that would give us a reason to eliminate that company as a potential GARP stock. In fact, if that company was trading at a good price, that's far more likely to be considered a value stock. Something like Intel would be a good example of that. It is growing somewhat, not too fast, but it's trading at a fairly good price. So that's much more of a value stock than it is a GARP stock. Okay, now to address the question that I asked a moment ago, how do we know how much growth is good compared to the current price? How do you determine what numbers are good numbers? And I think that one of the best methods to use, I've actually done a video on this in the past, is something known as the price to earnings growth ratio, or the PEG ratio. And to get the PEG ratio, we simply we calculate the price to earnings ratio. So you take the price divided by the earnings of the company, and then we divide all of that by the growth of the earnings. So that is the price to earnings growth ratio. So basically what we end up with is the price to earnings ratio of the stock divided by expected earnings growth. So let's imagine that we had a stock with a PE of 15x. Right now, to give us a point of comparison, the stock market's trading at about 26x. So our 15x looks like a pretty good deal. But let's imagine that we go one step further and we say that the earnings growth of this particular company is going to grow by 15%. Well, 15 divided by 15, and we get a PEG ratio of about 1. So 1 is actually a pretty good PEG ratio. I've seen many write-ups that people say, hey, you want to buy when the PEG ratio is below 1. And broadly speaking, this is fairly true, although I actually think it makes more sense to compare the company to its overall industry. For example, the Vanguard Information Technology ETF, basically tech stocks, has a PE ratio right now of about 35x. Again, a point of comparison, the S&P 500, again, is trading at about 26x, so this looks expensive when we just consider the price to earnings multiple. But according to Vanguard, they say that their earnings growth rate is about 22%. So this PEG ratio shakes out to be about 1.6. We compare that to something like the more conservative Vanguard Utilities ETF. Well, they have a PE ratio of about 25x, a little less than what the stock market is. But their earnings growth is just 5%. So their PEG ratio is about 5. So according to the PEG ratio, it would seem that technology stocks are actually better valued, or they are a better value relative to their growth than something way more conservative like utilities. Now, this makes sense from a growth perspective. If what we're after is growth stocks at a reasonable price, then of course utilities are likely not going to meet that group. They're not going to fall into that category. So using the PEG ratio can really help us define decent GARP stocks, or at least give us a good starting point for GARP stocks. So in theory, if we wanted to pay a reasonable price for growth, well, we should be able to find stocks that have a lower PE ratio or a PE ratio lower than their growth rate. If we find a stock with a price to earnings multiple of 25x and they have a growth rate of 30x, well, in theory, that is a lot of growth at a reasonable price. So it's not as simple as something like the PE multiple where it's, hey, this is too high or this is too low. It is relative to something which I think makes it a bit more dynamic and a bit more usable. Okay, now with this in mind, I've actually gone ahead and calculated the PEG ratio for a handful of Vanguard's sector ETFs to see what their PEG ratio looks like. So no matter what company we're looking at, we can use this list to have sort of a benchmark, a comparison point to compare our company to. What sector does your company fit into? Well, here's what the entire sector is doing. Now, there is one flaw to this information, and that is that this information, the earnings per share or the earnings growth, is based off of the past years, where a true PEG ratio should look at forward years, but that's much tougher to do with an entire ETF because of a lot of different factors. Are they going to change the ETF? What are all the projections going to be? There's lots of variables there. But either way, this gives us at least a starting point to identify maybe sectors we're interested in or what we can compare our company to. Now, if we also want to look for some companies as well, I went ahead and I calculated the PEG ratio for as many companies in the S&P 500 as I could. I found about 450 or 460 of them. And for these, I'm using forward numbers, which again is really the best number to use. You want to use forward-looking numbers. The downside to forward-looking numbers is you're relying on analysts to be at least somewhat close. That's really the only way of doing it, unless we want to calculate it ourselves, come up with our own forward numbers. So it's expected earnings and expected growth compared to today's price. And when we look at this list, well, there's a few companies that jump out at me right away. So a company like Disney has a PEG ratio less than 1. Now, I actually own Disney, and I happen to, you might have seen some videos I've done on it in the past. I actually think it's overvalued at this price. But I'm guessing the reason that the PEG ratio is coming out so low for Disney is that they have to compare. So to come up with earnings growth over the next 12 months, to come up with a growth rate, and it's not over the next 12 months, it would really be over the next few years. To come up with a growth rate, right now, Disney's earnings per share are very, very low because of how bad they got hurt with everything that happened in 2020. So with lower earnings today, well, the growth rate is going to look much higher than I think it will actually be if you compared it to, let's say, the average over the past 3 years. But again, this is the reason why we want to dig deeper after we identify decent companies that have low price to earnings growth multiples. Now, some other companies here to consider are companies like ExxonMobil, Phillips 66. There might be something in the energy industry that perhaps is propelling earnings to move higher or the PE multiple to be abnormally low. GE looks decent, although there's a history with GE. We'll have to look closer at that. HPQ is also a very interesting stock that has come up a whole bunch of times on both the live streams that we've done and over in the investing Discord. So I think this one could be worth a deeper dive because I've tried to value this over on the shorts channel. And again, it looks like it could be a good value today. And that's one stock I think we might talk about today on the private live stream. Again, today, 1 o'clock Eastern time. Now, I'm actually going to post this entire list of the S&P 500 stocks and what their PEG ratio is for each of the companies I was able to get. So if you're interested in joining our live stream or getting access to this spreadsheet, I'll leave a link in the description below to how to join the private community. It's through Patreon. And if you want to learn more about the PEG ratio, I actually did a video not too long ago where I compare Intel to AMD using the PEG ratio. So if you're curious to learn more about how to use the PEG ratio, I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.